Okay, folks, welcome back. I appreciate you being patient with me this weekend. We were celebrating our nephew's first birthday, so being the little stinker that he is, everyone stayed a little bit longer than we anticipated. So anyway, thank you for your patience. So we have their economic calendar here. It is absent of any kind of news drivers on Monday for Euro or cable. Tuesday we have 5 a.m. Euro, German Zoo, economic sentiment. And Wednesday, London Open, GBP, CPI, and PPI. Wednesday, New York Open, we have building permits for the dollar, medium impact. 10:30 a.m. again, high impact crude oil inventories. That's going to be specifically linked to the Canadian dollar's volatility as well, so just be mindful of that. And 2 p.m. we have FOMC economic projections, FOMC statement, and federal funds rate. And at 2:30 we have FOMC press conference. Big Wednesday for dollar. On Thursday at London Open we have high impact retail sales for GBP. And on Thursday's New York Open, we have the official bank rate votes, monetary policy statement, and official bank rate for GBP, medium impact asset purchase facility, and asset purchase facility votes. And 8:30 a.m., high impact Philly Fed manufacturing index for the dollar. And much like we have on Monday, for Friday, we have an absence of any real news drivers as well. So that's our economic calendar going forward. Be mindful that Wednesday and Thursday are the biggest heavy hitters, dollar and cable respectively. So let's move over to the charts. Okay, so we're looking at our daily chart for the dollar index. As I noted in the previous recordings, I mentioned on last Wednesday that we would probably see a run up into the rejection block. We saw that hit it beautifully, trade lower. Our attention and focus is in here, okay, which is the mean threshold of this bullish order block. Now, this is a target only. I'm not looking at it as a buy point. In other words, I'm not looking at this, see it hit and then trade higher. That's not what I'm suspecting is going to occur this week. I think it'll be a target. It may bounce up and trade into this bearish order block and resume going lower, attacking the sell side liquidity pool. We have another area of sell side liquidity with a volume imbalance down here and bullish order block that could be the next draw on liquidity. I mentioned several times now we have these lows here, and so many people have a trend line below that, anticipating some illusion of support based on diagonal trend lines. And I think that may be punished this week for the dollar index. If we get a further breakdown below here, the imbalance in here and then volume imbalance there, and then we have relative equal lows. Okay, so that would be an intermediate to longer term perspective on dollar. It's just a beautiful illustration here. All of this entire price action, go back and listen to the last 3 or 4 market reviews, okay? And you'll hear me talk about the very specific things that took place here. We had this run down, one candle, trade into the order block, and then if it comes back up and closes above the order block, which is it does, we would see a run going into the next week, bullish, that would make an attempt to get to this old high, which it did. Then I said that we would probably make a run for the rejection block here. If it trades through that, then we'll erase this entire wick and create a higher high. But the rejection block is where the market tagged and then went lower. That allows the foreign currency markets to rally. That means euro dollar can go higher, British pound can go higher, and so forth. Again, to get the maximum benefit of what has transpired here in the charts, again, go back and listen to the last 2 or 3 recordings and hear me outline the very things that's existing in your chart right now. Where we're at now, it looks bearish. I'm focusing long foreign currency, and then we'll see what we get from the rate announcement on GBP and the dollar index. So again, my eyes drawn here. I think the liquidity here is the significant draw in liquidity. In here is the short-term draw. This is the next downside objective, mean threshold. I'm looking at that as a speed bump, if at best. That's all we'll probably see. I'm not saying that we'll see any kind of bounce at all, but if it does, it'll just be a dead cat bounce and resume higher into the bearish order block and then roll over aggressively. That's what I'm anticipating. That's what I'm looking for in price action. So I may be wrong, and that's okay. But if I'm right, the signatures will be in price action, and we'll be able to capitalize on that, leading to a run to here and here for low resistance liquidity runs. Euro dollar. All right, so we had a really nice reaction down here on the old low. I just want to toss this in. We had a bullish order block here. We had that reaction trade there, and a lot of folks that have been exposed to my mentorship but have quit or feel like they understand it. They were anticipating this order block and this imbalance here to support the run higher, and they got smoked on Thursday. And that's the difference between being in mentorship and getting hand-me-down lessons and PDFs, because you don't learn that way. We're going to go into lower time frames and dissect that a little bit more, but near term we have this SIBI here, okay, that's defined by this high and this candle's low. So we have a little bit of imbalance to reach for, and then we have buy side liquidity up here and an equal highs here and a SIBI back here. Now this is really long term, but near term I'm looking for it to run up to here, and we'll probably see that this week. Dropping down into a lower time frame. All right, so here is that euro dollar chart from last Wednesday. Listen, folks, if you don't see these things after I mention it and get really excited about your potential as a trader, you're sleeping. Because we mentioned how the market could come down here, trade into these lows. If we lose the imbalance up here, and then there's a breaker, if we lose this, we would go lower into the lows, running into last Thursday's high, clearing that liquidity out. And you see that happen here perfectly. So for the ECB news driver on last Thursday, when I said last Thursday, here would be the week before, so I'll make sure I have that clarification. But last Thursday, from the time of this recording on September 14th, the 12th of September, we had an initial run here, clearing equal highs. Now I'm going to go down to a 15-minute time frame. It'll be a little bit more clear there, but you're only studying this. I am not suggesting, and I'm hoping that you're not being enticed by me running up that account aggressively just to prove what long-term experience can do with a small equity base. You don't need to fear how long it's taking you to learn, okay? Because in the right hands and capable hands, this content can produce miracles, okay, in terms of equity. But you cannot rush that process. You have to relax. But I want you to look at the signatures that were in the euro dollar and how it transpired. Everything I outlined on Wednesday, this day, we saw it happen here. Okay. Now, it happened in one of the most volatile news releases that can occur in the economic calendar, but yet it's still precise. Now, think about that. Let that sink in for a minute, especially the new folks here, because news many times buries a trader. The news events come out and they wipe out the account, they wipe out the positions, and it leaves you feeling like, man, this is so unfair. You can't grasp what's about to happen. So therefore, it's a mean market. They're out to get me. They're going to hurt me, and I'm never going to be profitable. It's easy to latch on to those ideas, but because you're being exposed to the higher order of order flow here, you can see that I have visibility. So you're in good hands. There's no reason for you to rush. There's no reason for you to feel uncertain or feel, because you haven't learned it yet, that you won't ever learn it, because it's going to be different for all of you. Okay, I have, again, 2016 members that had started with me in August of 2016, and they still don't feel confident. They don't know what it is that they're trying to do. And I personally believe that they're trying to rush it, and they're forcing something they believe they should be doing versus focusing on where their strengths lie and blooming where they're planted. Okay, so if they want to be a short-term trader, but they're really good at day trading only, is it smart for them to try to force the short term when their strength is day trading, or vice versa? So these are things you need to be weighing and figuring out as you go through the mentorship, being flexible all along the way, because I'm certain that whatever you start with when you first come in from month one, you have an opinion about what you think you should be doing by a certain time frame. You need to forget that, because that's not likely going to pan out. You're going to change your mind about all kinds of styles and approaches throughout your first 12 months core content, and then throughout the charter members, you're going to be tug of war back and forth with what you want to do. So again, let yourself fall comfortably into what you are being drawn to do. If you really want to do a time frame or style trading, but you can't get it to work, but you're starting to see other styles of trading using this content be more, I guess, obvious in the charts, then that's where you need to be focusing. And you can't twist and contort yourself into your preconceived notions about how you're going to find success, at least not initially, because you're framing that on the basis of ignorance. Like, you have no idea what you're going to learn here. So therefore, to have a preconceived idea about what you are going to define yourself as a trader as, being a position trader, swing, short term, or day trader, or even scalping, you have to let your unique personality line up with what the tools will speak to you with. It sounds esoteric. It sounds, like mumbo jumbo, really, but it's really how it works. So you have to allow your psychological makeup to being drawn to a specific price action model. And then when you pair those up together, you get really immediate response and feedback, and you feel comfortable. You don't feel that desire to do other things. Now, it doesn't mean you can't study and be better at other styles. It just means that you're going to use those other styles to amplify and or refine the model you're really designed to do. And you're not going to know what that is until you spend time in here. Okay, so let's go into the lower time frames and look at a 15-minute time frame chart for this. All right, so we have equal highs here. The market starts with a consolidation, and then at the news release of ECB, the first thing that happens is we spike up, and then we slam down right to the equal lows I mentioned, and then ran all the way back up, popped above the intraday high, clearing longer term pool of liquidity back here on the previous last Monday. Then we consolidated and then pumped it up one more time into a run above the previous week's Thursday. This looks like random price action. It's not. You watched me trade in this day. I went long, sold short again, sold out, went long, exited. I went short all through this movement here as well last Friday. Once you understand what you're looking for, okay, the highest order of trading using what you're going to learn from mentorship is the model that allows you to trade universally. Okay, so that's model 6 and 7. When you understand everything in the core content, on the amplified lessons, from the algorithmic principles and your trading plan that's fleshed out based on the things that we'll cover into 2020, you will be able to do 80% of what you seen me do last week. Okay. Thursday and Friday's trading, I was doing both sides of the marketplace. That is my Enigma algorithm. That part is not in the mentorship, and you're not going to learn it, so you don't need it. And to differentiate that and to settle the nerves on the people that see me say that, I have to be very clear, because I've never marketed my specific algorithm as the mentorship. I'm teaching you price action. In this framework here, what was the setup that was most likely to occur? The run down here into this area here where there was an imbalance. Because remember, last Wednesday I said that I don't believe that Euro is done with the week. I think it has not placed the highest high of the weekend. And I mentioned that we would go above the previous Thursday's high. That's here. Is that bearish? No. So couple that with running down below this short-term low, filling in any inefficiencies over here. That would be the buy side liquidity here, coupled with sell side liquidity resting below this low here, and in the imbalances over here, and in equal lows as well. Buying sell side liquidity and selling it to here where there's willing buyers at a higher price, the market efficiency paradigm. This is the move from here and then selling it above here to willing buyers. This is what mentorship tells you. This is the move. Buying here and then selling it to the willing buyers up here. That is mentorship. That's the side of the marketplace that being in here will put you on. That's the goal. That's where it's at. You do not need, and I'm not promising because it's my algorithm, the buying here, then selling short, then selling more, covering, buying long, and covering above here. That is my personal model. And it's unrealistic for you to expect to learn how to do that just in a couple years with me, okay? Because there's a lot of things that I can't teach you because I'm under an NDA that I can't disclose certain things. The one side of the marketplace that you are able to find the moves, it's the largest move, okay? So don't think about this move here and up here thinking, oh man, you're not teaching me everything. And don't think that the selling short here to here thinking, oh man, you're not teaching me everything. You need to think about what I talked about on Wednesday, that this was the move. This was the big move. Okay, remember the big move is going to occur on last Thursday, and it did. We went down to equal lows, picked up some more longs to distribute them above the previous Thursday's high. This is phenomenal trading. That's the smart money, elite entry, exit strategy. The whole model was outlined on Wednesday, and it panned out perfectly. On Thursday of the previous week, that liquidity was purged on Friday. You can't imagine how powerful this is. I mean, you're seeing it, yeah, it pans out great. But when you start seeing it, it's amazing because your confidence level goes through the roof. You don't fear missing moves because you know you'll find the big moves, okay? I'm outlining them before they happen. I'm giving you the parameters and the signatures to look for, what it will look like. And then now you have it in hindsight so you can put it in your charts and in your study journals and annotate them. I'm going to go back to the daily chart before we close our discussion on Euro. All right, so on the daily chart, we had this move here, rejection. We had this move here on ECB, and then rejection. This down here, I believe we've done the work for right now. In other words, I don't think we need to go any lower going into, say, October-ish. Okay, I think everything's bullish from here, and I'm going to trade with that idea going forward. Does that mean, now this is very important, this is a very critical distinction about what I just said. Does that mean every single day is going to be an up close candle on the daily chart? No. It just means that this is the eventual draw on liquidity, and I believe that they'll be wanting to attack all of these highs back, especially back here. This is for weeks now. I've been looking at this thinking this is likely to go. It's too perfect. It's too clean. We have this huge SIBI here, sell side imbalance, buy side inefficiency. So that will look to be closed in probably by the end of the year, especially if we get some wild sell-off in the dollar index. This will just send the euro up in the 1300s rather quickly. But for now, near term, everything looks like it's done its work on the downside, so it should be expansion on the upside. Right now, it just looks questionable. They've put their buys in here. They bought more down here. The signatures that we should see that would confirm what I just said is large, big candles on the upside. Okay, much like we saw on cable. Okay, same thing happened here. They accumulated more longs, break in market structure, run on liquidity, and then another break in market structure. Breaker, last up close candle before the down move, taking out the previous low. Wait a minute, Michael, you said the market structure was broken here and then it went down and ran the stops. It'll happen sometimes. That's where losing trades are going to occur. So if you're using market structure breaks and shifts in structure on the daily chart, you're going to have this happen sometimes. We have another break in structure here where the short-term high is broken. We come back down, dip into the breaker, the high between a previous low that makes a lower low. This is where they'll mitigate. Accumulate new longs, and expansion on the upside. We had an imbalance here. I mentioned this last Wednesday, 24.25. I even mentioned it on Twitter. It was public information at that point, and it was rather easy to get to and expand on the upside. The distinction between cable and Eurodollar was found with Euro Pound. I mentioned that we had equal lows here, and then we had equal lows here. And if that's going to be drawing liquidity, that's going to be allowing cable to outperform on the upside on buys, and Eurodollar to be weaker if there's going to be a sell-off. That's how you use this pair. If both of them are going to be bullish, it means that cable will be more bullish. So there's another gem for you for your study journal. Big explosive candle there. That's beautiful. I love seeing that. Now, where does it leave us? We close in this inefficiency here, and we have nothing in terms of inefficiency here. So what do you look for? Buy side liquidity. We have a fair value gap here. Buy side liquidity pool resting above this high here at 125.78. So we'll call it a 125.80 liquidity pool. Next intermediate term is here. And we have buy side liquidity resting below these equal highs, and then we can start going into these back here. We have a bearish breaker. That would be a level to look for, intermediate term to long, 128.65. Okay, so again, that's really looking out, but that's where we're at respectively. On an hourly chart, okay, go and look at the video from last Wednesday and on November 11th video. Scrub to about 34 minutes of the September 11th, 2019 video. And shortly after 34 minutes, you'll hear me outline the GBP move here. I mentioned that we have a imbalance here, and I'll zoom out a little bit. I said that we have a imbalance in here, sell side liquidity pool. We're going to drop down, fill in the inefficiency here, and then slam it up into the 124.25 level. And I said if it hits there, then we could possibly see a little bit of a sell-off, but it could also smash right through it. The distinction I made about this level was that it was merely the near-term draw, and I felt that we would go higher, not lower, on cable. It only went below the sell side liquidity pool to fill the inefficiency, trade into the breaker, and then off to the races it went. Follow Twitter, follow the commentary I gave you on Wednesday and the previous Saturday. Cable was going to be the outperformer on the upside. It was perfect. Okay, let's drop into a 15-minute time frame. I've already given you the long-term directional targets for cable relative to its daily chart. You can see the reactions here. We had 124.25. It hit it, smashed through like gangbusters, and then came back, finding some support, and then rallied through again into Friday, trading up into the big figure 125. Awesome, awesome, awesome move. All of this here was a move to inefficiency here, and the breaker. A low, the high in between, a new low. So they'll mitigate here, which they did. I'm going to zoom in here. I want you to really respect how precise the bodies are. Here's the candle's high, 22.90. Okay, 22.90. The bodies on these candles, let me take this off. Look at the bodies. This is the bulk of the volume. This is where interbank is going to see the bulk of the volume. Look at the close, 122.90. Look at the open on this candle, 122.89.8. Only off by 2 pipettes, but it's reacting off of that high, which is the breaker. It wicks into it only because this is the broker side. Okay, this is from the body's close to the wick's low, or the tail of this candle. All of that is going to be different across all brokers, because that's the part where they're reaching for liquidity or reaching for sell stops below the marketplace. Key low, that's the one they're reaching for in here. In your broker's liquidity pool, below this low, if there's orders like down here, they would have reached even further for that. That's how the broker uses its spread to tag you and move you out of the marketplace and purge you. Your stop needs to be below the midpoint of this breaker. From high to low, find the midpoint of that. Your stop needs to be below that. You can't just say, I'm going to put a stop below here like retail does. You need to frame it with institutional order flow and be outside the range. Well, that's a bigger stop, Michael. Yes, that means you'll have to trade with less leverage. It's okay. It's not a big deal. You have to compensate and adapt. But look at this reaction here. Again, 34-minute mark of last Wednesday's video, September 11th, to around 35 minutes and some change in terms of the seconds. But literally, it's to script. It's perfectly as I outlined it. Perfect. I mean, you can't ask for anything better than this. Now, you see the things I have to put up with on social media. People that doubt, people that think that there's some kind of tomfoolery, it's all hindsight, that none of this stuff could be shown in advance before it happens, and you all see it. So, the reasons why I react to these people online is because just like you probably doubted a lot of this stuff until you started seeing it. There's a lot of people out there that are on the fence about going into those free tutorials and spending any time learning because they believe the nonsense from other people that are just there to be a distraction. The teacher in me finds that offensive because I know how it was for me. I was looking for someone that knew what they were doing, and I didn't have it. I had books, and everybody in those books seemed like an expert to me. But as far as I could tell, Larry Williams was the only one that proved he made money with it. So I latched on to him. So I try to present myself through social media now, since I've incorporated and started the mentorship. Whenever I'm showing results, or if I'm referring to results, it's squeaky clean, straight and narrow, no tomfoolery. It is what it is. So they're all choking on that right now. They can't deal with it. But you all have been experiencing this every single week. Every single week, the things we cover in the charts are panning out, and they're happening on higher time frame charts. There's no funny money, no manipulating data for MT4 results, okay, like I've got accused of on Friday. It's all what you see. It's really me executing based on the things that I teach you, okay? These elements are going to be easier for you to see over time. You will not see everything by the timeline that you've established for yourself, because again, you stepped into this with ignorance. You don't know what you're doing, and you have no idea what you're going to learn. So to have a timeline on what you should know by this certain time is extremely unrealistic. You have no idea the depths of what we're going to be covering. And the charter members think they scratched the surface into, you know, understanding, and they haven't. It goes way deeper, way deeper. So you have to be prepared for a lot of content, but you don't need a lot of content to find a profitable model. And that's what we focus on here. The community, which you're being part of once you reach charter member, is that you get to be around all of us, and I continue to teach you more advanced things. You don't pay for it, but you're here as part of my community. All right, so now I want to talk about gold, and I'm going to cover a topic which is open float, and we're going to look at open float inside of a range. Okay, so and this is going to be for your study journal: internal range liquidity hyphen, which is a little dash, and you're going to write open float. All right, internal range liquidity dash open float. So we're looking at a 15-minute time frame on the gold market, and this high here to this low here is our apparent price swing. We have a lower level swing, which is this high to that low, and then we have a lower level swing within it, which is this high to this low. Okay. The common question is if I'm using a fib and I want to find equilibrium, or if I want to find optimal trade entry, which swing high should I use? Well, this high to this low is your parent price swing. You always first want to consider that. But then inside of that range, you want to look at how price has rebalanced. We had this big sell-off here, and then we came all the way back up and filled it in. In other words, what I mean by it, all these down close candles, price only went lower. And then we had this candle here, here, and here, where it spiked up right to the bottom of this last up close candle. So all this down move had been rebalanced with up movement. So it's kind of like that paintbrush analogy. Paint applied to the wall, stroke down, and then you stroke it back up to fill in any little spots that didn't get paint. And then it's free to go lower. Okay, that's what rebalance is. Since this high to short-term low to this high, this has been rebalanced. We don't put our fib on this high. We use this one. Why? Because this swing has imbalances. This high rebalanced all these down close candles. Now these down close candles need to be rebalanced up to this candle's low, right at 1509 and 98 points. We'll just basically call it 1509. The high to this low here is now our dealing range, because we don't need to worry about this high because it's already been rebalanced. So price is only going to be reacting and keying off of the range between this high and this low. So inside of that range, there's going to be liquidity. That means above this low and below this high, all this range, internally speaking, what is the liquidity that exists within that? Well, let's take a look at it. We have this candle's low to this candle's high. In here, that midpoint is this red line, which it hits it right there perfectly. Okay? It also is basically the middle of this low to this high range. So this bearish order block, essentially, that's the midpoint or mean threshold of that same level. Okay? In this area where this line is, between the mean threshold of the bearish order block and the midpoint of the fair value gap in this form is a SIBI, sell side imbalance, buy side inefficiency. The midpoint is there. With that being said, we know that there's going to be a large pool of internal range liquidity at this area or at that price. What's the price? Well, the line shows essentially 1508. Okay, so 1508, round that to the nearest 5 level. What would that be? Remember, if we're down here and we're coming up, reaching for liquidity, the nearest 5 level would be what? 15010 or 1505? 1505, because you're going to round down, because again, the effect of spreading open to absorb liquidity is a function of the broker side. Trading to the specific price levels is interbank level. We're talking about internal range liquidity and open float. Where is the resting orders above this consolidation? In other words, what I'm saying is in here, when price was hanging down here, we know that this candle's high, I'm sorry, this candle's low, and this candle's high here, there is a gap. We split that in half, that's this level right here, and it's 1508. Down here, what's the nearest 5 level to this level here without going over it? 1505. So you could be a seller at 1505 in here with the expectation that we could see a run all the way up to this candle's low and into that candle. So your stop has to be above that. Okay. Secondly, we have the range itself, the high to the low. We have optimal trade entry here, 70.5 level, perfectly hit here, 2, 3 times, and then expansion down. Okay, we have relative equal lows. You could be a seller here and buy it back below these equal lows. The fib, with that proper swing from high to low, we can use our targets, which is 127 and 162 expansions on the fib, calling for 114.85. Okay, so 114.85 would be our downside objective, and the market trades down into a low of 114.85. Okay, this area here, we had a SIBI, sell side imbalance, buy side inefficiency, and you could be a seller here at the bottom of that candle there. So we have a bearish order block, SIBI, off to the races. So a seller here and a seller here. Notice that those signals occur at and above equilibrium between the low and the proper swing high. This is open float within internal range liquidity. We're going to talk a lot more about these types of events, but I want to kind of like bring more into the depths of why I don't need market profile, footprint, ladders, DOMs, depth of market, all those things that are out there that feel like makes you like institutionally minded. It's not needed. It's not needed. Everything between the open, high, low, and close tells you everything. The only element you need next is time. Okay? So until I talk to you over the week that's coming, I wish good luck and good trading.